Open any social feed today, and you're hit with a barrage of crypto alerts, day trading gurus, and complex ETF strategies. It looks exhausting. The financial entertainment industry is heavily incentivized to sell you this activity. The more you trade, tweak, and panic, the more money they make off fees and attention. But the objective math of building wealth points in the exact opposite direction. The highest statistical returns come from doing almost nothing. If you feel completely overwhelmed trying to pick the perfect stock, or if you feel like you are falling behind peers who flaunt luxury lifestyles online, you aren't alone. We are going to strip away the hype. We'll look at the data to prove why a quiet, deeply boring financial strategy mathematically beats trying to outsmart the market. This quadrant chart plots effort against financial return. Down in high complexity, low return, you find day trading and crypto. Up in low complexity, high return, you have broad index funds. Financial independence means trading the thrill of complexity for the endurance of simplicity. When you are just starting out, there is a widespread assumption that generating your initial wealth depends entirely on getting high investment returns. This stacked bar chart breaks down how an initial $100,000 net worth is constructed over 6 years. If you average a 7.5% return, a massive 77% comes purely from raw savings discipline. Only the top fraction is actual investment growth. To get this engine running, you have to aggressively push your savings rate up. That requires tracking exactly 3 numbers: your fixed expenses, your savings rate, and your net worth. It also requires strict boundaries. You must firmly cap fixed expenses like housing, transportation, and utilities at no more than 50 to 60% of your total income. You also have to entirely avoid financing depreciating assets. Taking out a loan to buy a new car, expensive jewelry, or furniture means you are literally paying a bank to lose money. At the beginning of your financial journey, your raw savings rate is vastly more important than the specific assets you choose to buy. Once you have cash ready to invest, a lot of people fall into the trap of overcomplicating their portfolio. They buy 10 to 12 different ETFs, assuming that makes them a better, safer investor. This comparison table reveals the diversification illusion, contrasting a complex portfolio against a single S&P 500 ETF. If you buy a standard S&P 500 fund and add a mid-cap value ETF, you get a 92.1% overlap. They hold the exact same companies. You aren't actually diversifying. You are duplicating your holdings, creating administrative confusion, and mimicking a single index fund with significantly more effort. The counterintuitive solution is to consolidate. Pick a maximum of 3 broad index funds, set up auto-investing, and practically lose your password. Over a 15-year period, passive index investors who simply bought and held outperformed 92% of highly paid Wall Street fund managers. The optimal investment strategy sacrifices cocktail party bragging rights and dopamine hits in exchange for overwhelming statistical superiority. Of course, holding a simple portfolio requires serious psychological endurance when the market inevitably drops and the news cycle induces panic. This scatterplot maps market price to earnings ratios against the probability of making money over a short 5-year timeline. If you buy when stocks are expensive and only hold for 5 years, you hit this dense cluster of red dots, indicating high chances of negative returns. But look at the mathematical anomaly that occurs when the investor simply refuses to sell. As the timeline stretches out to 20 years, the red dots systematically disappear. Historically, over any 20-year period, U.S. stocks have had no real negative returns when including dividends. Apply that to real-world panic. In 2012, investors feared the market was 50% overvalued. Those who let anxiety win missed out on a decade of massive financial gains. Time in the market mathematically eliminates the risk of bad timing. Boredom and endurance are your most powerful financial tools. The final hurdle to this blueprint is behavioral. It is the external pressure from pure comparison and social media highlights that causes people to abandon long-term plans. It's easy to fall for the illusion of the 30K millionaire. These are individuals earning average salaries who spend every dollar they have to project an image of extreme wealth. Data shows that actual wealthy people live well below their means. They do not dress or act like the affluent stereotypes seen online. If you compare your aggressive saving phase to someone else's heavy spending phase, you'll feel deprived, which directly leads to disastrous short-term decisions. If your primary motivation is to look rich today, you will inevitably sabotage the discipline required to actually become rich tomorrow. True wealth generation isn't an intellectual test of picking the right stocks. It is a test of behavioral control. This scorecard lays out the final criteria required to execute the boring wealth blueprint. You must track the big 3 numbers. You must hold fewer than 3 index funds. And you must entirely ignore the spending habits of your peers. This path is perfect for the overwhelmed beginner or the time-poor earner. It is a terrible fit for those who view investing as entertainment or a quick status boost. Risk is highly personal. Stop seeking excitement in your portfolio. Embrace the boring path. Zoom out 20 years and let compound